and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, as you may have heard, both the stock and bond markets have gotten off to a rip-roaring start this year. And that meant that basically everyone and their dog was predicting that Fed Chair Jerome Powell would come out to the podium this week and ruin all the fun for everyone. But he didn't quite do that. And stock prices continued to rip higher. Bond yields continued their descent back to earth. So what's the deal? What's going on? Doesn't the Fed still want to tighten financial conditions? We'll get into it with a chief investment officer from a firm I think you've probably heard of. But Valdana, before that, I've got to play a little word association with you.
Okay.
If I say to you, the song remains the same, what's the first thing that pops into your head?
Jerome Powell. No,
Jerome Powell?
I don't know. Yeah. Jerome
Powell is the first thing that pops into your head. All right. How about if I say the end is near? What pops into your head?
I don't know, some apocalyptic movie. I'm really
fair.
bad at this. Okay, I'm really bad at this.
So, well, to me, it's my old record collection because I think this week's guest has a similar record collection to mine. The song remains the same as, of course, Led Zeppelin. Song, album, and movie, I believe. And I'm not sure, but I think he was referring to Sinatra with The End Is Near, but we'll have to find out.
Okay, you're just dating our guest, basically.
I'm dating myself a little bit, too.
Yourself
and
our
you
guest,
just showed off
which is
that
not nice.
You're too young to know who Led Zeppelin is. You didn't have a jean jacket in the 80s with the huge Led Zeppelin patch on the back?
Obviously not.
Yeah.
Did I? You're asking me? No. I was born in 1989. Hello.
Oh.
Okay, so let's see if our guest is mad at being dated by you, but it's Jim Caron. He's co-chief investment officer of global balanced funds at Morgan Stanley Investment Management. And Jim, thank you so much for joining us, and apologies for Mike's comments.
No, my pleasure. I'm glad he got the references. Those were exactly the references. And I did have a jean jacket in the 70s and also in the 80s. I did have like the little pins on the jean jacket. And part of the reference, too, is that the record label for Led Zeppelin was Swan Song. So the other reference is that this is also a swan song for the rate hiking cycle. So there's a lot of references that are going on here.
Multi-layer there. All right. I do understand this finance stuff after all, Valdana.
I clearly don't.
This stuff should be on the CFA exam for sure. But it's funny, though, strategists realize they'll get a lot of readers of a certain age to read their stuff when they throw in those classic rock references. So I applaud you, Jim. I definitely want to get into the markets talk, but I was just going through your background, and it's funny because I have this recurring dream where I'm back in college for a second bachelor's degree, and everyone's like, what are you doing getting a second bachelor's degree? I'm like, I don't know. It just felt right. But I find it fascinating, your education. So bachelor's in physics from Bowdoin, then another bachelor's in aeronautical engineering from California Institute of Technology. Very interesting background, and it's always fascinating to me the different paths people take to Wall Street. A lot of times it is that physics or engineering background. So what were you thinking back then? It sounds like you wanted to be a rocket scientist when you were a kid.
Yeah, that's probably correct. So I was on a program, what was called a 3-2 program. So I spent 3 years at Bowdoin, got a physics degree, and then went to Caltech to do engineering. And I always loved the markets, and I always thought of the markets as almost like a financial engineering experience. That plus the fact that I was graduating during a time where there was a big recession, a big peace dividend was being paid. The Berlin Wall had come down. A lot of the engineering work was going into the defense sector, which was being, eliminated pretty much. So I really started to get interested in the markets, and that's where it led me. And I loved all of the math and the complexity that was going through at the time. And it was actually when Bloomberg in some ways was in its infancy. And today people take it as a granted. But I used to do a lot of my calculations on a calculator called a Monroe. And that was the Bloomberg of the time. That was the high technology of the time, was one of those big hand calculators. So I really have an appreciation for how things get done, how things come together, how things actually work. And I think of the broader markets as almost like a machine or an engine in some ways, where everything needs to be just right for it to run smoothly. So that's the association that I have between the engineering and science background versus what's going on in markets today.
I really like that, and I like your description of it. And it's a perfect segue into what is going on in markets today, because we did hear from the Fed. The tone of the press conference was very different from what investors had been expecting. So maybe just like lay out for our listeners, what did we get from the Fed and what your main takeaways were from the presser?
So I think it's very interesting to the extent that Powell is really trying to walk a very, very fine line, to the extent that he wants to signal that the rate hiking cycle is coming to an end. And he even made reference to that. And he said, we're talking about a couple of more hikes. Well, a couple to me means two, possibly two. But at the same time, he doesn't want to let financial conditions become very, very easy, have stock markets go up, have credit spreads tighten very quickly, and all of a sudden bring in those inflationary pressures again. And that would really work against him. So in one sense, he wants to say, I'm slowing the pace of rate hikes and I might be coming towards the end, but the terminal policy rate has not yet been determined. Now, obviously, if you say we have a couple of more hikes to do, or we're coming towards the end of this, we can all do the math and say, well, then the Fed's either done in March with the next 25 basis point rate hike, or they're done on May 3rd, which is their meeting after the March meeting with a 25. So they're either done at 5% or 5.25%. And I think that is essentially what the market started to key off of. If we think back to what the December summary of economic projections were, so the big meeting before this meeting that we had on Wednesday, it basically told us that the terminal policy rate was going to be somewhere between 5 and 5.5%. And now it seems like that's even coming down to a more truncated 5 to 5.25. But let's just say by the end of the second quarter, the Fed is done. Probably by the beginning of the second quarter, the Fed is going to be done. And I think the markets are taking some solace in that, and you're seeing interest rates come down and you're seeing equity prices move up as a result.
Yeah, and it's interesting. And he even referred to the past where they would, hike rates every other meeting, almost, perhaps signaling that that's a possibility, that maybe they'll pause in March and then come again in May. But what's I find fascinating, Jim, is, all of Wall Street, the financial world, watching Powell's press conference on one screen, and on their other screen, they've got the markets, whether Bloomberg Terminal or I don't know, if there's something else other people use. But
is there anything else people use? No.
I don't know. But, I almost wish Powell had the benefit of having a terminal in front of him when he's speaking, because you don't quite, the question is always, did he sort of not get the intended message that he wants out? Is there going to be some hawkish commentary coming from some of the other speakers in the next few weeks, and from himself to sort of walk back this loosening in financial conditions that we have? I mean, we really quite loose all year, and looser after the press conference in terms of, stocks ripping higher, yields and spreads coming in. Do you think we'll get a little bit of that, a reminder that, hey, we're still going to keep these rates high, we're not going to cut this year? Is there sort of a whiplash to expect in the coming weeks?
There was whiplash during the press conference. So yes, I think this is a great question, because this is one of the risks that I think that we have coming up over the next few weeks, is that if the intended market reaction, if there even was one, doesn't match what the intended statement was supposed to convey, then, as is typical, there's going to be some walking back of this. And I want to really highlight this, because I think it's extremely, extremely important. What Powell said in the statement was viewed as relatively hawkish, right? And then all of a sudden he starts his press conference, and he basically says the exact same thing that he said back in December. It was almost a carbon copy of the issues. First one was that labor markets remain tight, which is keeping inflation risks elevated. Second point that he made was he started to call out, despite the decline in CPI and wage inflation, it's still too high to be consistent with inflation becoming anchored at target levels. So he's still worried about it. And then he goes further and he starts to talk about, again, exactly what he talked about in December, the service sector inflation versus the goods sector inflation. And he said, look, we know why inflation's coming down. Durable goods, supply chains, all of these things are certainly coming down, but service sector inflation is not coming down as fast as they like. And then he even went further, he upped the ante on that even more. And he said that, in fact, the service sector inflation, if we look at it, core services X housing, again, core services X housing, that's what he's looking at, and that's what we should all be looking at. He said, hasn't even started to fall. So as I'm listening to this, this is a guy who's worried about inflation. This is somebody who's not done tightening by any stretch of the imagination. And then he said that was about 30% or the majority of, or a large part of the core PCE index, which is what the Fed's favorite gauge of inflation is. So if the core services X housing hasn't even begun to fall yet, and they look at the core PCE index, he still believes it's going to be elevated. Then he went on even further to say, wouldn't it be a shame if just when we had inflation on the brink of being, a solved problem, that we didn't tighten enough, and then all of a sudden it started to resurge later on? That would be really bad. And to me, that is my core risk. If somebody asks me, what's the risk that keeps you up at night, aside from all the geopolitical potential risks, the risk that keeps me up at night is that we get this decline in inflation in the first half of the year, which we know is happening. But all of a sudden we realize in the second half of the year that it's not anchored. It comes down, but then all of a sudden it starts to show signs that it may start to bubble up in 2024 and beyond. And then they have to come back in and start hiking again from an already high base. The markets do not have this priced in. Everybody's talking about the pivot in Fed funds and the expectation for rates to come down and what have you. It would be a significant surprise and really bad for asset prices if, in fact, that this all got turned on its head and all of a sudden the Fed said, no, we actually have to restart our hiking cycle, or we started to price that back in. If that were to happen, if inflation became unanchored, and he mentioned this, this is him saying this. So this does not sound like a person that is ending their inflation fighting plight. But then in the second part of the press conference, he went on to say, yeah, but you know what, we're probably just talking about a couple of more hikes. And then he became a lot more dovish, and the market just seized on that. So I do think over the next couple of weeks, we're going to see other Fed officials come out and try to rebalance that statement so that there's two-sided risk in the market, that it shouldn't be taken, according to the Fed, as a done deal, that they're done, that there may still be more to go. And I think this is really the key here, which is creating confusion. But, obviously in March, there's going to be a new summary of economic projections, their forecasts for the next quarter, or not just for the next quarter, but for the next few years. They redo their forecasts, and we'll have a better understanding as to what they see in terms of inflation expectations and policy expectations.
So I wonder, that risk that's keeping you up at night, how do you categorize it? Is that a tail risk, or do you think that's something we're really got to worry about? And what would cause that sort of resurgence in inflation? Would we need some sort of exogenous event, oil price shock or something like that? Or is it just a matter of, look, this is uncharted water and inflation can be unpredictable?
Yeah, so let me split the difference on the level of risk, and I'll say it's a fat tail risk, right? So it's a tail risk, but it's a fat tail, meaning that it has a higher than ordinary probability for the event to occur. And I would even subjectively put that as high as 20%, right? Which is, to me, that's, we can debate if 20% is a tail risk, right? I mean, it's a reasonable risk, but it's not, to me, it's not in the majority. So what creates that? Well, certainly energy prices could do that, right? Certainly that is something that's out there. We know that there's been, not enough production relative to the demand, and we know all of the different factors there. Energy has come down for various reasons in the second half of 2022. It started to come down, and it's still staying relatively low. But to me, that's not really the main issue here. The main issue is the labor market. The labor market is what's perplexing everybody, and everybody has different theories and different views on it. And there's one thing in common, is that most models really just haven't worked in terms of trying to predict labor. And the issue that we have right now is that there's a lot of tightness still in the labor market. Look, we got a JOLTS survey that came out, this past week, and essentially it showed 11 million job openings, right? So the job openings actually ticked up. They haven't been going down as expected. Again, baffling most people's forecasts. The other is that the vacancy to unemployment rate, so the number of jobs open for every unemployed person, is sitting at about 1.9 to 1. Let's call that 2 to 1. So there are 2 jobs open for every unemployed person. So while consumer confidence is coming down because we're hearing about layoffs in the tech sector and these big gargantuan numbers that are being thrown out there, the reality is that when we look at jobless claims, when we look at the unemployment rate, and when we look at the BLS surveys and statistics, what we're finding is that these people who are being laid off in the tech sector are finding jobs in other areas. Now, the nuance here is that the jobs that they're finding are lower paying. So now I want to be very, very clear about this because I think this is an important point to make for 2023. 2023 is going to feel worse to Main Street and better to Wall Street. 2022 felt worse for Wall Street and better for Main Street. So look, if we look at 2022, what we saw was inflation going to 40-year highs. We'd have to go back to the 80s and the 70s to see the levels of inflation that we had. We had gas prices going up to sky-high levels and all of these various things. But what we also had was job creation. People were employed. The jobs market was still very, very strong and had started to weaken. So even though higher prices were coming into the economy, what people realized is that, well, they had a job. They could pay the higher prices. They would still go out to eat at restaurants and spend time at hotels and go on airplanes and do all these various things. So even though, yes, all of that bad economic stuff was happening, and certainly the bond market took notice of that. Bond yields rose quite a bit. Certainly equities took notice of that. We all know what the performance of 2022 equity prices were, but the consumer felt okay. Now what we're seeing is we're coming to the end of this inflation cycle, at least for now. It's starting to come down. We're coming to the end of this rate hiking cycle. So rates are coming down. Equities are responding positively. Bonds are responding positively. If you ask people on Wall Street, hey, look, things are pretty good. If you ask people on Main Street, they're saying the exact opposite thing. Now, why this now all of a sudden becomes a lot more important is that 2023 and going into 2024 starts the year of the political cycle of a presidential election. So all of these discussions around how do we control inflation, and I always think it's very informative that every press conference that Powell has started going back about almost a year now, he starts off by apologizing to the American people. He says, listen, we're sensitive to everybody's pain. We know that there's the unemployment rate, that the employment situation may get worse in the future, but we think it's a necessary thing to do to control inflation. The reality is that the unemployment rate has stayed relatively low. The jobs market has stayed relatively tight. So what that tells us is that if we do get into a situation where we do get a slowing in the economy, but the jobs market stays relatively robust, people still have, consumers still have dollars to spend, and consumption is 70% of GDP, that we could all of a sudden start to get a resurgence in demand. Now, remember, when the Fed hikes interest rates, what they're trying to do is push down demand. But if we get through this soft patch, this corrective patch of Fed policy, inflation, and everything else, and we come through this with a soft landing or maybe a mild recession, then we're going to come out of that like wild horses, right? And that wage inflation, could then go on to create what Powell calls and what central bankers call the wage price spiral inflation. And he always says, look, there's no evidence of it yet, but as soon as we see it, game's already over, right? So you never want to get to that point. And so that's why that's the risk that keeps me up, is that I think that there could be some underpinnings to say, well, let's slow down the hikes right now because, we need to be sensitive to, politically and everything else, but it doesn't do the inflation fighting job. Yeah. And then we have a worse problem a year later.
11 million job openings out there too. It's, that labor market is still red hot.
So Jim, what did you make of Powell almost taking a victory lap when he said this is the first time that the Fed can actually admit we are seeing disinflation, which was a comment that really struck me.
I think he wishes that he could take that word back because as soon as he said that, the markets took off like a rocket. I mean, you could time it to that statement.
Yeah. And he was only referring to goods prices too, specifically, I think.
Well, see, now you were paying attention. Other people just heard the word disinflation and they hit the buy button and they just left their finger on the button until all their orders were filled. Well, that's right. And I think that's going to be part of the walk back is to say, well, when I said disinflation, what I really meant was goods disinflation. And that should be a good, he's getting too nuanced in these things, right? You have to really be a professional listening to this. I think most people are kind of listening to it out of one ear and then they're trading in the markets, at the same time. So, yeah, I think that he's correct in saying that about goods prices. I wish he framed it differently because I think it just creates more volatility in markets.
Yeah. Can I also ask you then, just to go back to our discussion about financial conditions, because obviously the Fed doesn't want looser financial conditions, but and we already mentioned this, they are looser because of the rally we've seen in the stock market, etc. Powell said that they've tightened significantly, that the Fed is looking at financial conditions on a longer term versus a shorter term time frame. And then the discussion on Twitter was like, okay, where is he looking? Like, what models is he looking at? Because, even if we look at there's a Bloomberg financial conditions index that has just loosened significantly since when they started hikes last March. Like, what do you make of this discussion? What might Powell be referring to?
I love that you're asking this question. It's a question that most people use the words financial conditions and they don't quite understand what that is. And it's actually questions that I've actually gotten. I've gotten this question exactly because there are various ways to calculate financial conditions. And let me just start from the top and just say, financial conditions are really a measure of how how market prices are reflecting central bank policy. So then it becomes, okay, well, what market prices? What market indicators are you looking at? Because in theory, if you increase policy rates, you should get a weakening of financial asset prices. That's just the way these things work. But now we have to create financial conditions is actually an index, right? So now we have to create and I know Bloomberg has an index of financial conditions as well. It has a lot of different variables in it. The 5 principal components of financial conditions, meaning that the 5 factors that drive financial conditions the most, where you're going to get 99% of the information, is going to come from 5 things. Number 1, short-term interest rates. That could be 3-month T-bill rates. That could be policy rates. Let's call it 3-month T-bill rates because that's something that we can measure in the markets, right? That's something that we can watch. The second would be intermediate term treasury rates. And that would be, call that the 10-year treasury yield. Again, another market measurable item that we can use to reflect central bank policy. The third is going to be BBB credit spreads. So that tells us something about the credit conditions in the markets. The fourth is going to be the equity market. So let's call that the S&P 500 broadly. The fifth is going to be the trade-weighted value of the U.S. dollar. Those 5 are the big 5. Those matter the most. Now, you could say, well, what about home prices? And how about oil? Or how about we could throw 100 different things in there. The problem statistically when you do that is that you end up like losing the information. So those 5, if you did a PCA, principal component analysis on financial conditions and reflected that to central bank policy, those 5 are the ones that matter the most. So it's an index, meaning that there's a weighting that gets attached to each one of those 5 variables or 5 components. And then you come up with a number, right? And that becomes your index. It's just like it's like calculating any old index. And that's what you measure. So when we look at financial conditions, I would say that financial conditions, have become easier, but they've also tightened a lot. Just look at what happened last year. Credit spreads widened, interest rates rose, The dollar got very strong. So a stronger dollar is weaker for financial conditions. If you have, it just makes your exports more expensive and it's harder for, for companies to make money in that sense. Obviously, higher interest rates, higher cost of capital, higher credit spreads, tighter credit spreads are weaker for financial conditions, weaker equity prices, all of those things. So financial conditions actually tightened quite a bit. Recently, with the decline in interest rates, the decline in the dollar, the decline in credit spreads, the increase in equity prices, those have now recently started to ease financial conditions, but only after they've tightened a lot. But they're not easier today than where they were a year ago. They're still a lot tighter than where they were a year ago. But there has been an easing of financial conditions over the past, say, 4 or 5 weeks, just given the market. So when Powell's saying, I'm not concerned about short-term financial conditions, I'm really more concerned about longer-term, I think what he's basically saying is like, look, as I come to an end of the rate hiking cycle, and people start to price in more stable interest rates and possibly even lower interest rates at some point, of course, in the near term, you're going to get an easing of financial conditions because I'm not tightening anymore. But longer term, these are the long and variable lags. The fact that they may keep the policy rate at 5%, let's say, for an extended period of time might actually tighten financial conditions because they're just going to keep the cost of capital, keep the cost of credit higher for a longer period of time. So he's just saying, look, I'm not trying to micromanage the markets by looking at financial conditions. We have to think about what our policy decision and keeping our policy decision in place is going to do for the longer term. And that's essentially what he's saying.
Jim, if I'm remembering your resume correctly, you were a rate strategist for a long time, right? And now co-chief investment of the Global Balanced Funds at Morgan Stanley Investment Management. This is how I segue into the part of the podcast. I call it the just tell me what to do with my money already element of the podcast. Obviously from a balanced fund perspective, last year, nothing worked. 60-40 was, just a nightmare. This year, I got to think back from the dead for 60-40 or whatever your preferred ratio is to some degree. I'm curious how you're thinking about it. Whatever your allotment is to, if it's not 60% to stocks and 40% to bonds, are you tweaking that ratio at all, do you think, maybe in favor of bonds? And specifically in fixed income, anecdotally, there's a lot of bankruptcy talk swirling around. If these rates stay higher for longer, are you worried about credit spreads? Are you leaning more towards just safe treasuries in that fixed income bucket? So how are you thinking about portfolio composition as a whole, I guess, is to boil it down?
So this is a key issue here for this year, and not only just for this year, but even over the past few years. It's really about the portfolio construction. So what a global balanced strategy does is it tries to look across multiple assets, fixed income, equities, commodities, currencies, and tries to put together a balance of risks that creates an optimal risk-adjusted return. And that's what our strategy effectively does. And the idea right now, or the problem that we have right now, is not a new problem. And this is something that I'm glad you're asking this question, because this is an important issue for us, which is that we have a high correlation in markets right now. So if we go back to 2018, we had high correlation markets there where fixed income and equity didn't work so well together. So the 60-40 didn't work. 2019, the 60-40 portfolio worked well because all of a sudden, equities and fixed income went up. 2020 was an odd year. It was the year of the pandemic. But ultimately, by the end of the year, the 60-40 portfolio did well because equities went up in price and bonds went up in price. So far, going back to 2018, what I've highlighted is that we've been in a high correlation market in 2018, 2019, and 2020. Now, as we go to 2021, we also had a very high correlation market. We had fixed income and equity doing poorly, and people tend to notice high correlations when fixed income and equity do poorly. And now here we are in 2023, we also have a high correlation market. Both fixed income and equities are doing well. People ignore high correlation risks when both assets are doing well, but they tend to notice them greatly when both assets are doing poorly. The point that I'd like to make is that we've been in a high correlation market for the past several years. And I think this really puts a lot of stress and pressure on the 60-40 portfolio. So to answer your question, more directly after that preface is, so what do we do is what we need to do is we need to balance a portfolio. We need to think about how we balance the risks, meaning that how we look at equity risk, how we look at fixed income risk. If they're both going to be highly correlated, your traditional 60-40 isn't really going to work the way that it did in the past, because what we have to remember is the reason the 60-40 portfolio worked so well, having 60% equity and 40% bonds, was because the bond market fell, basically performed well in 36 out of the last 40 years, except for last year, right? So we had a bull market in bonds for 40 years just about. And essentially, bonds were a good hedge for anything. But now, as we get to a point in the economic environment and the structure of the economy where risk-free rates are going to be higher, I think we're going to have inflation issues and risks for the foreseeable future for the next 5, 7, 10 years. And you're going to have more variability in interest rates. So now all of a sudden the 60-40 portfolio doesn't work as well as having a static allocation. So what we have to think about in terms of hedging and creating a more dynamic, better portfolio that optimizes risk-adjusted returns is trying to manage the volatility. So in other words, if what the 60-40 portfolio was supposed to do for you was give you a stable return profile, what I'm saying is that in that static 60-40 portfolio, you're not going to get that anymore. You haven't been getting it since 2018. But what you need to do is target a volatility. What you have to say is, if I want to pick a number, I want a 7% return, right? But I want a 7% return, but I want that within a range. I don't want to take on too much volatility to get that 7% return. So I want my volatility to be in a range between, say, 4 and 10%, right? I'll accept that as an acceptable range for my return volatility. So really what we have to start thinking about today is not the static 60-40 portfolio, but really trying to target the volatility of the portfolio so that you can manage your return profile in a more stable range. And what that allows you to do, the big benefit there, is it allows you to compound your returns over time in a more stable manner. That's what the 60-40 portfolio was able to provide for like since 1980. And what we've seen since 2018 is that 60-40 hasn't been working as advertised. And that's what I would say is start thinking about strategies, like the one that I manage, effectively that thinks about stabilizing the volatility of returns to have a more balanced portfolio.
But Jim, you mentioned you expect inflation to be an issue for the next 5, 7, 10 years. So what do you see happening with inflation? Because we've had some guests on the podcast the last couple of weeks who've said they don't see, they sort of see inflation, the downturn in inflation topping out at around 5% maybe and staying around 5%. So what do you see?
Well, even if the downturn in inflation tops out at 5%, that's way above the Fed's target of 2%, right? So now we have to think structurally about what's going on from a very macro perspective, right? So when we think about why inflation started to fall and when did it really start to fall precipitously, I mean, obviously it peaked in the early 80s under Volcker. He killed inflation, hiked rates a lot. But then all of a sudden, we had a big change in policy under President Reagan. He moved more towards a supply side economics type of a solution. And what he did was he deregulated, and essentially what he did in the supply side economics is he increased the productive capacity of corporations to make supply meet demand and bring down prices. So you can have higher growth and lower prices. And that was really the miracle of the 80s that then spilled over into the 90s. By 2001, we had another big event. China joined the WTO. And, China was a factor in the 90s as well, but really started to come online, starting in 2001. Now we had globalization and offshoring of production and all of these various factors. And that was it for inflation. We didn't worry about it, until 2022, right? Inflation just came right down. So now what do we know that's going on? Well, globalization is now in deglobalization, effectively. We're not offshoring production, we're onshoring production. Energy costs are a lot higher. There are a lot of various, for good reasons, climate change initiatives that is constraining some of the production of energy. So that's something that's out there as well. Energy, and we also have to remember, feeds into fertilizer prices, food prices, and everything else. So that all of a sudden really starts to bring inflation in prices of a lot of goods and consumables like food also a lot higher. And we're not at a point structurally where we're increasing the productive capacity to meet that demand. So that's structurally where we are. We are at a structural change in the markets today. On top of that, we had this awful pandemic. Sadly, many people left the workforce and aren't coming back. And that's created a lot of constraint in terms of labor. So now labor is really in charge, not capital so much. And labor being in charge are going to demand higher wages. You get higher wages, you get higher inflation. Structurally, that's where we are. Nothing's turning that around. Look, there are arguments that we've been in this period of secular stagnation for a long time, and it's only been interrupted, and it might reassert itself. I'll take that on board as certainly a possibility. But so far, I'm not seeing any real evidence of that. So I'm much more concerned about the fact that we are structurally moving into an onshoring, deglobalization, higher cost of productivity situation. Now, the only thing that solves this problem is higher business productivity, CapEx, business investment. Productivity is output per hours worked, right? So if you can maybe rely on technology, robotics, AI to do the work of people that you can't find and hire, then that will bring down, wages, essentially. But that's the measure that we're looking at right now. And that's why I think that inflation is going to be with us for a while. It takes a long time for companies to become a lot more productive. Do need a supply side response, which means that you need, that's a fiscal policy. Fiscal policy creates a supply side response. That's taxes, regulation, to generate CapEx and productivity and things like that. We are nowhere near sending a message to the American people saying, I know everybody is suffering right now with higher wages and higher inflation and what have you. And the answer to that is to cut taxes for corporations, right? Because that's the way the narrative will be spun. It's wrong. That's not exactly true. But that's the way the narrative will be spun. And it's going to be hard to get that supply side response. Until we get that supply side response where the productive capacity of the economy is increased to make supply meet demand and bring down prices more durably, we're going to have an inflation problem. That's how it was solved in the 80s. That's how it'll be solved again. It's just a matter of when, and I don't think it's anytime soon.
Great stuff. We really appreciate your time. We cannot let you go, though, until we hear the craziest thing you've seen in markets this week. Vildana, as always, why don't you get us started?
Okay, I have one that I chose with you in mind.
Ooh.
And I really hope you haven't seen it yet. So it's a nice surprise. Okay. A Porsche dealership in China.
All right.
Does it ring bells? No? You haven't seen this?
No. And why a Porsche dealership in China made you think of me? I'm dying to find
listen.
that out.
Okay,
Yeah.
a Porsche dealership in China, they put up an online ad for I don't know this car, but maybe people do, Panamera,
Okay.
a type of Porsche, I guess.
Yep. Yeah.
But they accidentally put it up for $18,000 instead of the starting price of $148,000.
Oh my gosh. Did they actually have to sell any at that price?
So I guess hundreds of people immediately put in bids for it or tried to buy it or however this process works. And they had to apologize and pull the whole thing. But Porsche did say that they got in touch with the very first person who made the online reservation and they, quote, negotiated an agreeable outcome.
That's pretty
a
good.
steal.
Boy,
You can't even get a used car for $18,000.
I was going to say,
used Mazda.
China's CPI would have gone negative for the quarter if that if those sales went through. That's pretty good. That's pretty good.
Thank you.
Although I still don't know how Porsche made you think of me. I'm like a Volkswagen Beetle.
Oh,
type
because
of guy.
so just so listeners know, Mike has 4 Porsches.
Yeah, right. Little
No,
models,
because
little
I
plastic
knew you
models.
would like the poster for 18,000
Oh, I do.
was
Yeah.
supposed to be 148.
I
Yeah.
like a good fat finger trade.
Yeah,
Of course.
exactly.
All right, that's a good one, Vildana. I'll hand it to
Thank
you.
you.
Jim, how about you? You see anything crazy recently in markets?
Well, I don't have anything to compete with a $18,000 Panamera Porsche. I wish I was the first person to actually see that. I would say that it's more of a change in sentiment and thought, where the growth sector was just so hated for so long. Anybody that you spoke to, going back over the past few weeks, would say you're crazy if you think that. Look at the NASDAQ, look at some of these high tech stocks, and they're laying people off, and the earnings are terrible, and how the earnings announcements have come down so much. But yet, looking at the markets today, it's just bewildering. Maybe not as bewildering as the $18,000 Porsche, but it's to me, it's in the same category of how in the world can this be happening with all of this bad news that's out there. So not as interesting, but it's where my mind went.
Is that just a sort of a high beta reaction to this sense that the Fed's going to cut this year? I mean, I assume the rate. These people must be assuming lower rates to be buying growth stocks like that, or is it just January mean reversion? Maybe.
I think it's a couple of things, and the thing I'll attribute it to is that people have a lot of cash and they're underinvested. And as I like to say, risk on is a risk. And if you're underinvested and the market goes up, you have a lot of explaining to do. So you end up chasing the things that went up the most. And unfortunately, or maybe fortunately, people are chasing these higher flying, high beta names. And maybe we get to silly levels at some point and it doesn't end well, but who knows?
Yep. That makes sense. All right, my turn. Vildana, are you having a Super Bowl party this year?
No, I'm gonna have like a Super Bowl funeral. The Bills aren't playing.
I thought you jumped on my Eagles bandwagon.
Oh, I am an Eagles fan now. Yeah, I love the Eagles. Right. Fly Eagles, fly. EAGLES. I have an Eagles jersey.
Oh, how about
so that? I wore it for the last game, and it brought good luck.
Yeah, keep wearing it then.
Yeah, right. I will.
Good. I'm not having one because a little too passionate. The potential for violence is too great to have other people around. But if you are having one, USA Today has a story, some good news. Now, Jim gets us to read his notes with good Led Zeppelin references. The other thing a strategist can do is somehow tie the football, the Super Bowl into their research. So Wells Fargo, they looked at inflation on items popular at Super Bowl parties.
Okay.
So, and the good news is that there does seem to be some disinflation, but not in everything. So I'm going to make you guys play the little game show here, The Price is Precise, and guess what has happened to prices of avocados over the last year. Avocados, obviously super important for guacamole. Mm-hmm. And Jim, no pressure. I don't really expect you to know what avocado inflation has done, but I'm still going to make you play The Price is Precise and guess. I'm
going to say they're up 4x. I'm going to say 4x because I know these things have gone up crazy because I love avocados and guacamole and all. Is that close? Am I close?
I'm going with the under.
You're taking the under?
I think avocado prices are down. I bought 6 avocados this week for $4.99. So I'm going to go with yes. Am I wrong? Oh my gosh, I'm wrong. Should I redo my answer? I'm going to say that prices went down.
You buy them 6 at a pop. That's a lot of avocado toast.
Well, I'm a millennial.
Oh, that's true. That's why you're broke.
That's
why the good news for you millennials, they're actually down 2000%. I agree with Jim.
I was going to say 20%.
Actually down 20%. They were, but I think it's a little mean reversion there too because they did go through the roof there for a while. But more importantly, all right, you can get some vengeance here, Jim. Restore your reputation here. Price of beer, an even more important ingredient for a Super Bowl party. What do you think beer's done year over year? Vildana, you go first.
Oh, gosh.
Oh, I go first this time. Okay. Well, obviously it's gone up. Otherwise, you wouldn't have chosen it. I'll go with up up 15%, between 10 and 15%.
That's some good psychology there.
Yeah.
I don't know. I'm not saying it was the right. Maybe I went reverse psychology on you. Jim, what do you think fear did in the last year?
I'm going to say up 20%. Yeah, I'm in that same category.
Up 11%. So you guys
are. Oh my gosh, I'm so good.
You're in the right ballpark. Yeah. Okay.
I was in the right ballpark. Jim, Eagles or Kansas City? And there's only one correct answer.
Oh, yeah, I know. So admittedly, being from Boston, my team is the Patriots. Yeah. So they're out, but that's okay. So I think it's going to be the Eagles that win. I think it's going to be a really good game, but I kind of like to see Kansas City win.
No. That's the wrong answer. Yeah. That's the wrong answer.
I know. But
Can we cut this podcast short, please?
Will win. I said too late for that.
Well, I'm a little too emotionally invested. I'm not going to make any predictions. I don't want to jinx anything. I hope both teams have fun. How about that?
Oh my gosh, that's the most diplomatic answer I've ever heard. Don't worry, I'll wear my jersey.
All right, you wear your jersey. Jim, Caron, such a pleasure to pick your brain. I hope we can bring you back sometime and do it all again.
Absolutely. I had a lot of fun with this.
Thank you, Jim.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Reganonymous. Vildana Heinrich is at Vildana Heinrich. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.